All right, everybody, welcome to episode 3 of Money and Stuff. I'm your host, Sam Rodriguez, certified financial planner. If you haven't listened to us before, like I said, a certified financial planner, been doing this for a little over 17 years now. With me, as always, is my co-host, Connor Shepard. By
Hello,
always,
hello.
the whole 2 times we've done this before, man. You've been with me all the way.
Hey, I'm here. I'm here, ready to rumble.
Yeah, yeah. So welcome to Money and Stuff. Mostly so far we've talked about money, but we added this stuff because we want to leave it open, right? See what else there is to talk to. Eventually we'll have some guests on here, and who knows what they want to talk about. Maybe not money, maybe just stuff. So what do we got on the agenda today, Connor?
Well, I know one question that we've been getting a lot recently is from people asking about, should we be paying off our mortgage as soon as we can? Should we be making more, putting more towards our, monthly payments? Just really thought we'd talk about the ups and downs of that decision and just kind of go
So
from
like
there.
should I put extra towards my like an extra payment or extra amount on towards my mortgage on a monthly basis, or just pay my mortgage off, like that kind of stuff?
Yep.
Yeah, yeah, you're right. You're right. We do like, not only are we getting that question now, I think my entire career that's been a pretty consistent question. Right. And I guess that makes sense, right? When you think about your mortgage, I mean, it's a pretty big debt, right? Like it's
Mm-hmm.
you think about things that loom over you, whether you have credit card debt or student loan, or, a car. Your mortgage is most likely going to be the biggest debt that you ever have. Hopefully your mortgage is the biggest debt you ever have. Hopefully your student loan isn't bigger than your mortgage, and hopefully you didn't buy a car that's more expensive than your mortgage. Uh,
Hey, some people live in the moment.
yeah, that's right. That's right. Or maybe it paid off for you. I don't know. But yeah, when it comes to the mortgage, right? Like huge. And you get that statement every month and you see this huge balance. And I got to admit, like, that's even when I see my mortgage statement, that's a question I ask myself from time to time. I'd really like to just get this thing gone, because it's huge. It sort of looms over you, and no one likes the feeling of this massive amount of debt
Mm-hmm.
sitting over them. So yeah, so let's talk about that a little bit. And I will say, I think this has been so far a pretty consistent theme in answering questions. Is the answer is, it really depends. It depends on a few different things, right? It depends on the interest rate that you're paying on that mortgage. It also depends on what you would do with the money, whatever that extra money is, whether it's a monthly amount that you would put towards the mortgage, or if it's a lump sum amount that you would put towards the mortgage. If you didn't put it towards the mortgage, what would you do with it? Right? Like that makes a pretty big difference. So I guess I can go through some of the reasons we see why people are,
Yeah.
thinking about it. Some of the things that we hear a lot. I'd say one of the things that people have a hard time with when they think about having a mortgage, and because mortgages go for so long, right? 15, 20, 30 years, people realize how much interest they're going to pay over the life of that loan. And
Mm-hmm.
it is a large amount. So, you know, it it's very easy to look at that and say, if I got this thing paid off earlier, or if I put any money towards it now, I save quite a bit on interest. And I
Mm-hmm.
mean, you can save tens of thousands of dollars on interest just by putting extra money on a monthly basis towards your mortgage. I think that's one of the most common things I hear. Going back to the debt looming over you, I think a lot of it has to do with just peace of mind, right?
Mm-hmm.
I think, in financial planning and what we do for people, most people are working with us because they want some peace of mind, making sure they're making the right decisions. Seems to be what everyone's searching for.
Mm-hmm.
But thinking about having a plan to rid themselves of this large debt, I think gives people some peace of mind, you know, and knowing that they're going to pay it off sooner, right? Like,
Mm-hmm.
putting a little extra towards it. You know, instead of having a 30-year mortgage, maybe it turns into a 24-year mortgage. You know, one of the other things that I hear pretty often is, you know, I think it'll help build equity quicker, right? You know, you got a $500,000 house with a $300,000 mortgage. You know, every extra bit that you put towards it builds equity faster, right?
Yeah.
Less debt equals more equity. So, you know, in terms of my advice for that, again, it really does depend, right? But I think right now, for the majority of people have a very low interest rate on their mortgage, right? Especially if you finance within the last 12 months, you may have something that's 3% or possibly even lower, right? So what you got to ask yourself is, if I didn't put that money towards the mortgage, what would I do with it? And if I did something with it, would I earn more than the interest rate that I'm being charged, right? So
Yeah.
I would say, if you were just going to store that money in a bank account or in a savings account, and I think they're as high as like 0.1 cent or 1% interest rate now, right? I think that's probably not going to be the best use, right? You're not making more money than you are spending in interest. But if you are willing to invest that money, right, I think it's a better idea to save it for a few different reasons. One, let's say you're earning a pretty modest rate of return, right? And yes, I know market's going to return different in different years, but let's say on average over the life of that loan that you're getting a 6% interest rate, right? I mean, as long as you're paying lower than a 6% interest rate on your mortgage, then it most likely makes sense to have that money set aside instead, and for different reasons, right? So for me, what I really like about setting the money in some sort of investment account, or instead of putting it towards the mortgage, is I like the flexibility, or what I call position of choice, that it puts you in. So for example, let's say that you have $250 extra every month to put somewhere, right? If you put it towards the mortgage, that choice is made, right? You can't go back. If you needed money for something else, or if there was an opportunity for something else, you couldn't go back and say like, hey, I know I put $250 in, you know, every month for 3 years. I really need to tap into that so I can go do this over there, right? Like, it's the choice is made, right?
Yeah,
but
the deal's done.
Yeah, deal's done. No, no. What are you talking about, right? So, but if that money's been sitting in an account and working for you, as long as you set it in an account that's accessible, right? Not putting it in an IRA or putting it in an annuity or anything like that, but putting it somewhere that you can get your hands on it, then you'd always have the opportunity to take advantage of an opportunity, meet some sort of need that pops up, or if you wanted to, at some point later in time, actually apply it towards the mortgage if you so chose to, right?
But it leaves that pool of options open to you. And I mean, I think there's definitely something to be said, you know, speaking back to the emotional weight of, you know, looking at that such a large debt that you have and that you're always having to pay off. You know, it is definitely much more stressful and much more, or it creates a lot more anxiety for people when they are very limited in what options they have financially. And so I think in terms of, obviously, you know, it's easy to just say, hey, don't think about it. But I think viewing it as, well, maybe I'm not paying my mortgage off as, you know, sooner. I have this pool of options of what I can do with that money instead. And I think there's something to be said for that, sort of mitigating a lot of that stress and emotional pressure.
Yeah. So I think most things regarding finance, right? It's like, hey, like you mentioned, like you said, just don't think about it. Like, I think, unfortunately, I think that's the advice a lot of advisors give their clients on a lot of things, right? Like, market's going crazy. What am I supposed to, just don't think about it. Everything will be fine, right? Like, Okay, let's give some real options, right? Because the fact of the matter is you're going to think about it, right? Whether
Hmm.
it's your investments, your mortgage, whatever, you get a monthly statement at the very least. So you're
Hmm.
always going to be reminded about it, right? And I, I completely agree with you. I don't know about you, but a lot of times for me, it's when I finally lay down to try to go to sleep at night and it's quiet, when the things I haven't been thinking about suddenly come into my mind, right?
Yep.
And, you know, for me, I overanalyze and I go through all the situations before I can, all the different options and everything that could happen and what I would do about it before I can fall asleep. And this really, I think, does give people peace of mind to know I have created this pool of money that gives me a lot of options.
Hmm.
And honestly, if you look at it, I've done these calculations for clients several times where I will work out and I'll say, if you have an extra whatever, 250, 300, 500, $1,000 a month, whatever the number is, I say, if you put it towards your mortgage, here's how much sooner your mortgage would be paid off.
Hmm.
And what I'll tell you is that if we take that same dollar amount and instead put it to work and it's growing, it will actually grow fast enough that there will be a lump sum of money that you will be able to pay your mortgage off with
Yeah.
much sooner than if you were to take that money and apply it straight to the mortgage. And
Hmm.
that's simply because investing is likely, again, to outpace the interest rate that you're paying. And one thing that's important to remember, right, is even if you were earning the same amount on your investment as you were paying, or same rate, I should say, same rate on your investments as you were on your mortgage. What you got to remember is that interest rate on your mortgage is on an ever decreasing balance,
Hmm.
right? Where the interest rate on what you've been putting away is on an ever increasing balance.
Hmm.
So they don't work out to be the same, right?
Yeah.
So as long as you're earning a rate equal to or greater than the interest rate that you're paying on the mortgage, financially, it makes more sense to save it and give yourself some options.
Yeah.
One thing I should say, talk about peace of mind, right? Like our job as advisors is to make sure you're on track, but also think of the worst case scenario, right? Worst case scenario is for some reason you lose your ability to make your monthly mortgage payment, right? Like what happens, right? You still got bills to pay, you still got to put food on the table, you still got to live, and you want to keep your house. Well, the reality is you can be far ahead on your mortgage, but you're still going to owe the same amount every month until the mortgage is paid off. And if you
Hmm.
start falling behind on that mortgage, no matter how far ahead you are
Yeah.
of schedule, there's still going to be consequences, right? They can
Yeah.
still foreclose on that house, right? But if you had that pool of money set aside and God forbid something did happen where you didn't have the income to be able to pay the mortgage, at least that lump sum of money was there that you could tap into to make those mortgage payments until you got back on your feet and could get back on schedule,
Yeah. Yeah.
so I think you're
Uh,
right. You hit right on the peace of mind thing. I think it does give people peace of mind knowing they're taking some action to it,
hmm.
but kind of shifting their thinking towards I still am taking action to it. I'm just taking a different action that gives me more choice.
Yeah. And I think, you touched on it well there in terms of like you want the money working for you. I think a good way to view it is, it's not just taking however much, you're thinking of adding to your mortgage payment to try to pay it off sooner. You're not just taking it as cash and stuffing it in the mattress and just, letting that build. It's I mean, you can if you want, people can have their own ways of saving money, but viewing it as, I'm taking action with it and it is actively working for me as a, it's there's growth there, and viewing it not just simply as, oh, well, I'm just setting it aside for when I want to potentially pay off my mortgage, more down the line. Or if I end up where I do need a rainy day fund, it, at the very least, you can look at it as I'm not sure exactly what I'm going to do with that money, but I know that it is ever growing and just ever increasing.
Yeah. Yeah. And I'll tell you, one of the other things that I've had people say when I talk about this is they'll say, well, as soon as I get the mortgage paid off, here's how I'm going to make up for what would have happened had I been saving this money. They'll say, as soon as the mortgage is paid off, I'll start saving what I was paying towards the mortgage and the extra money I was paying towards it.
Mhm.
I've done the math. It doesn't work out better. It doesn't work out nearly as well as if you just saved the whole time, right?
Mhm.
And that's the case right now, right? Interest rates are super low. If interest rates start crawling back up, if we start seeing, above 5, above 6, above 7 interest rates, then it's really going to depend on how you're invested. Right. And I should say, I should have probably said this at the beginning, but it also not only what you would do with the money, but also what your tolerance for risk in the portfolio is, right?
Yeah.
Because I know I said, even if you get a 6% rate of return, annual rate of return, and I said, a modest rate of return at 6%, it's not going to be a steady 6%, right?
Mhm.
Some years will be better than that. Years will be lower. So you also have to have the emotional wherewithal to withstand those ups and downs of investing.
Yeah.
One thing too, when I was talking about building equity faster, I think in terms of, instead of just thinking about equity you have in your home, you should be thinking about your net worth overall, right? Your
Mhm.
net worth being your assets minus your liabilities. So, when you think about your house and the equity that you're building, you're thinking about the value of your home minus the amount you owe on it. But if you think about it from a net worth standpoint, you think about assets versus liabilities, right? And if you take your value of your home minus what you owe on your home, but then you add in what you've been saving, right? You're still increasing your
Yeah.
overall equity portion or net worth. It's just not all in your house.
Yeah.
You're likely going to be increasing it at a faster pace because that money is growing much
Yeah.
faster.
Yeah. And, I think just touching back on the, it part of it is, it depends on your risk tolerance. It just goes back to that broader, probably something we'll say in almost every episode, if not every episode, but, everybody's situation is different. And so it just is going to depend, if you like your risk tolerance, your current financial situation, your overall, just a lot of factors play into it. So I think
Yeah.
that's just something for everybody to keep in mind,
Yeah, for
that
sure. For sure. When you ask a financial advisor a question about what you should do, the first answer should almost always be, it depends. Like that's
absolutely.
maybe that's like the title of the podcast is money and stuff, parentheses, it depends,
It
right?
depends.
It depends. So so but speaking of risk tolerance, we get a lot of clients that say, well, I'm getting into retirement, right? Like I don't have that appetite for risk anymore. So that can play a factor into it, and especially as they get into retirement, clients really want to reduce their expenses,
Mhm.
right? They're saying, if I can reduce my expenses, I can increase my cash flow.
Mhm.
Right. But there's two pieces to cash flow, right? Yes, there's expenses, but then the other piece is income, right? So you got to think about, okay, if you didn't pay your mortgage off, and typically, I'll say this, typically, if people are very near to retirement or about to retire, they're thinking of taking a large chunk of money from everything that they've saved and paying their house off all at once right before they retire, right? And it works, right? It does reduce your expenses, but you got to think about it from a income versus expenses to get the true cash flow, right?
Yeah.
And like I said, cash flow has those two components. So, you're thinking about lowering your expenses, but you also need to think about, well, is there the possibility of increasing my income? So let's say you have a $500,000 house, right? Completely paid off. And let's just estimate that or let's, for example's sake, say you have an income of $5,000. Okay. Well, with with no mortgage, you've got free cash flow every month of $5,000 to pay your bills and do things that you enjoy doing, right?
Hmm.
So you've got $60,000 a year to do that with. If you had a $500,000 house and you went into retirement with a $400,000 mortgage, that's a pretty big mortgage to go into retirement with, right? But let's say you go into it with that $400,000 mortgage, but that also means because you didn't just pay the house off, you have $400,000 set aside,
Hmm.
right? Again, it all depends on what you do with that 400,000. So, well, if I were to say, let's just say today you could get a 3.25% interest rate on a 30-year mortgage. You would end up paying 1741 a month for your mortgage, right? So you have increased your expenses by $1,740 a month.
Okay.
But if you took that $400,000 that you did not spend on your mortgage and put it to work, and again, let's just use 6%, right? Something that should put you at a pace of growth in retirement that's not uncomfortable from a
Hmm.
risk perspective, right? If you said, the 400,000 plus growth, I want to be able to create a steady income for 30 years before I drain this 400,000.
Yeah.
Well, the income or what you'd be able to take from that 400,000 every month would almost be $2,400, right? So you're paying, yes, you've increased your expenses by over $1,700 a month, but you've also increased your income
Yeah.
by more than that. So
Exactly.
you'd have what, almost about 650 extra dollars per month of
Hmm.
income, right? So
Yeah.
you've actually increased your cash flow by putting that money to work instead of just reducing your expenses, right? But
Hmm.
again, all depends on your tolerance for that risk. But you think about that, right? I was saying $5,000 free cash flow on a monthly basis or 60,000 free cash flow a year. That changes it from 5,000 to 5,650 a month, or I think so. Let's use the calculator, right?
Break
650 a
out
month
the
times
old
12.
calculator.
So you've taken your income per month from 60,000 a year to 67,800.
Hmm.
Like dude, like that's almost $8,000. Like, think of the things you could do, right? Like, you could have a better retirement. You could set more aside. You're more likely to leave something to your heirs, right? So
Yeah.
creating that free cash flow right now with mortgage rates as low as they are, you can really take advantage of it to actually create more cash flow for yourself in retirement, even if you go into retirement with a mortgage. So
Yeah.
I really think right now, if you have the risk tolerance for it, if you can know that it's not going to be steady, but that you can earn these rates over time, I really think for the most part, from a financial standpoint, it makes more sense to not put the extra money towards the mortgage and to put that money to work, right?
Hmm.
But that's one piece of it, right? As you know, when it comes to helping people with finances, there's the dollar and cents and what makes the most sense financially, but the emotional piece is pretty huge,
Hmm.
right? Again, some of it is that tolerance for risk. Will that fluctuation of your returns or the print or the watching the balance of your principal fluctuate, will that give you more stress or anxiety than knowing that you have options, or
Yeah.
will the mortgage continue to to weigh on you,
Yeah.
So those
Well,
factors to consider as well.
definitely. And, I'm sure there's some people out there that would be curious, but if you were to just look at, risk tolerance on one end, very conservative, very close to the chest in terms of how they want to go about investing or, putting that money to work versus somebody playing fast and loose, very high risk tolerance. What are some ways that people would be able to put that money to work for
Sure.
themselves?
So, I'd say the easiest way, or what most people have access to, is either mutual funds or exchange traded funds, right?
Yeah.
And if you don't have an advisor, there are mutual funds that you can buy that actually create a very diversified portfolio for you according to your risk tolerance,
Okay.
right? So you can actually buy a mutual fund that says this is designed for someone who's an aggressive investor, or you can purchase a mutual fund that says this is designed for someone who is a very conservative investor, right?
Yeah.
You can do that. Or, you need to talk with your advisor about options, right?
Yeah.
What options do you have? But I would say for someone who, um, wants easy access to something to make their money grow, those are probably going to be the easiest, don't have to put a lot of thought into it options
Hmm.
that they do have.
And
Yeah.
apply it and that apply across the board in terms of, from the least risky to willing to put it all on blackjack.
Yeah. Of course, there's a lot of options out there, but if you want an easy sort of hands off, pick something, put it in there, don't have to think about it very much approach, that's very easy to do.
Yeah.
Obviously if you use an advisor, then it's up to your advisor to think about it, right? So you can
Yeah.
put that on them, right? And that's something that we do for clients, right? Like every client that we talk to, it's always about, obviously we want to know their risk tolerance, but we also want to know their risk tolerance per goal, per money set aside for those goals, right?
Hmm.
Because you might feel differently about the money that you've set aside that you would have paid off the mortgage with than the money that maybe is going to be used for your retirement, or maybe the money that's going to be used to, I don't know, buy yourself a vacation, whatever it is.
Yeah. Yeah.
You might think differently about it. So you've got to, when you think about the risk tolerance and what you use to put that money to work, you can't treat every pool of money you have. I mean, you can treat it the same, but I would say you really need to think about each pool of money you have, what you're designating that money for, the amount of time that money you're willing to set it aside, and
Hmm.
what your feelings are about that particular pool of money.
We've solved the mortgage crisis.
That's right. That's right. Yeah. So I think it's that simple, right? I think it depends on what rate you're paying. And right now, with interest rates where they are, if you're not paying, say, sub 5% or below 5%, you should probably talk to someone in the mortgage industry about refinancing your house to a lower mortgage rate. I think most people are in the threes or below right now. But yeah, with interest rates the way they are, I think that's one thing that makes it in favor of not putting the money towards the mortgage and putting the money to work. The second thing it depends on is what you're going to do with that money if you were to not pay the mortgage down faster, right?
Hmm.
Again, if you were going to put it somewhere that wasn't going to earn anything, maybe that's not the best thing. There still could be some reasons to do that, right? Like you still have the choice of what you do with that money, but it makes it an easier choice to set that money aside for savings if you know that money is going to be growing, right?
Hmm.
And know that one thing that I really like about setting that money aside, I talked about putting yourself in the position of choice. What I really like about putting yourself in the position of choice is if down the road you realize, no, I just would really feel better if I was putting that money towards the mortgage. At any time, you can change your mind.
Yeah.
You can take that money, start putting it towards the mortgage, or even take the chunk of money that you saved up while you were trying it out. You can just take it out and pay your mortgage down with it. So it gives you, like I said, that puts you in that position of flexibility and position of choice. So I
Yeah,
really, really like that option when it comes to whether or not you should pay your mortgage down.
definitely.
I think that's it. Another episode done.
Hey, there we go.
Yeah. If any of you guys who listen, if you have questions, if there's something you've been thinking about, feel free to contact us and shoot us a question. I don't think there's anything financial related, a financial related question. I can probably speak to it. I guess, if you want to send other questions, sure. I just don't know.
If you have questions about stuff, we'll do our best. Can't guarantee it.
I can't guarantee that I'm going to offer expertise on it, but I guess I can talk about it.
Yeah, I mean, hey, I'm sure we could spin the yarn on whatever.
Right. That's right. All right, guys. We'll talk to you next time. Thanks a lot.
Securities offered through LPL Financial, member FINRA/SIPC. Investment advice offered through Foundation Wealth Partners, a DBA of Advisor Resource Council, a registered investment advisor. Foundation Wealth Partners and Advisor Resource Council are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.